The Rule of 72. The formula they teach you, but not what it reveals. What if I told you that one of the simplest formulas in finance also raises some of the biggest questions about the financial system itself? It's called the Rule of 72. Most people learn it as a simple investing shortcut. Divide 72 by your annual rate of return, and you'll know approximately how many years it takes for your money to double. Earn 8%, your money doubles in about 9 years. Earn 12%, about 6 years. Financial advisors love this rule because it demonstrates the incredible power of compound interest. They're absolutely right. Every young person should understand this principle because it can completely change the trajectory of their financial life. And one who consistently invests even a modest amount each month has something incredibly valuable on their side: time. Those early investments don't simply earn returns, they earn returns on previous returns. Over 4 or 5 decades, those dollars may double 5, 6, or even 7 times. Waiting until your 30s or 40s means losing doubling periods that can never be recovered. Time is the greatest asset a young investor has. But here's where the conversation becomes much bigger. The Rule of 72 doesn't only apply to investments. It applies to debt. It applies to inflation. It applies to housing prices. It applies to government borrowing. It applies to the national debt. It applies to the expansion of the money supply. It applies to virtually everything in our financial system that compounds over time. And that's when I began asking a simple question. If so much of our financial system depends on things continually doubling, what happens if they stop? Before exploring that question, it's important to define 2 terms that are often used, sometimes carelessly, in discussions about the economy. A Ponzi scheme is a fraudulent investment operation that pays returns to earlier investors using money contributed by newer investors rather than legitimate profits. It survives only as long as new money continues flowing into the system and eventually collapses when that flow slows or stops. Pyramid scheme operates differently, but it shares one important characteristic. Participants near the top generally benefit from recruiting additional participants below them rather than creating lasting economic value. As the structure expands, those entering later often bear the greatest risk, while those near the top receive the greatest rewards. To be clear, it is my personal opinion in saying the global economy is literally a Ponzi scheme or a pyramid scheme. It's all fraud. Look into my previous videos on how and why I believe the entire system to be legalized theft. Even a number of economists, investors, and monetary critics have argued that our modern debt-based monetary system shares certain structural similarities to a Ponzi that deserve examination. One of the most well-known critics is Mike Maloney. Maloney argues that modern fiat currencies are created primarily through lending. Governments issue bonds, businesses borrow to expand, consumers finance homes, vehicles, education, and everyday purchases, and commercial banks create new money through the lending process. Every new dollar enters circulation alongside a corresponding debt obligation. From this perspective, debt doesn't merely finance the economy, it creates much of the money circulating within it. Critics argue this creates an important consequence. As existing loans are repaid, money effectively disappears from circulation unless new loans replace them. If borrowing slows significantly, the money supply can contract, economic activity may weaken, businesses may struggle, and asset prices can decline. In other words, the system increasingly depends on continual credit expansion. Central banks attempt to manage this process by influencing interest rates, purchasing government securities, providing liquidity during financial crises, and acting as lenders of last resort. Supporters argue these tools stabilize markets and reduce the severity of recessions. Critics see something different. They argue that each financial crisis has required larger interventions than the one before. Interest rates trend lower over time. Central bank balance sheets expand. Government debt grows. More liquidity enters financial markets. Asset prices continue climbing, requiring even more debt to sustain valuations. The key idea is that newly created money doesn't enter everyone's pockets equally or at the same time. Instead, it typically enters through the financial system, which tends to push up the prices of financial assets before it affects consumer prices. Economists refer to this as the Cantillon effect. Here's how critics describe the chain of events. Step 1. The central bank lowers interest rates. When interest rates fall, mortgages become cheaper. Businesses borrow more. Investors can borrow at lower costs. Governments can finance larger deficits more cheaply. Cheap credit encourages more borrowing throughout the economy. Step 2. Banks create more money through lending. Under modern banking systems, commercial banks create deposits when they make loans. Suppose someone borrows $500,000 to buy a house. Before the loan existed, that purchasing power didn't exist in the economy. Once the loan is made, new bank deposits are created. Multiply that by millions of mortgages, business loans, and government borrowing. More money is now competing for roughly the same number of assets. Step 3. More money chases assets. Where does borrowed money usually go? Houses, commercial real estate, stocks, private businesses, venture capital, bonds, increasingly, cryptocurrencies. When demand rises faster than supply, prices tend to rise. Step 4. Rising asset prices create a wealth effect. As home prices rise, people feel wealthier. They borrow against home equity. They renovate. They spend more. As stock portfolios rise, people invest more. Retirement accounts grow. Businesses issue stock at higher valuations. Consumer confidence often improves. Higher asset prices can feed additional spending and investment, which is one reason policymakers sometimes view stable asset markets as supportive of the broader economy. Step 5. Investors search for yield. When interest rates are very low, savings accounts pay very little. Government bonds yield less. Investors begin searching elsewhere. Money flows into stocks, real estate, private equity, venture capital, high-yield bonds, gold, Bitcoin, and other cryptocurrencies. This is often called the search for yield. Why stocks often benefit? Imagine a company earning $100 million every year. If interest rates are 8%, investors may value that company less because safer investments already pay attractive returns. If rates fall to 2%, those same earnings become relatively more attractive. Higher valuations often follow. Cheaper borrowing also allows companies to build factories, acquire competitors, buy back their own shares, refinance debt at lower costs. All of those can support higher stock prices, although valuations still depend on corporate profits and investor expectations. Why crypto sometimes benefits? Crypto doesn't receive money directly from central banks. Instead, critics argue it often benefits from excess liquidity. A simplified chain looks like this. Lower rates equal more borrowing, which leads to more liquidity, which leads to more risk-taking, which ultimately leads to more money flowing into speculative assets such as Bitcoin, altcoins, startups, and technology stocks often rise. During periods of abundant liquidity, investors are generally more willing to take risks. During tighter monetary conditions, many speculative assets, including cryptocurrencies, have often experienced greater volatility. Why I compare this to a pyramid? This is where critics like Mike Maloney and myself, among others, make our comparison as a literal accusation of fraud. Their argument is as follows. Asset prices rise because more credit enters the system. More buyers can borrow. More money competes for assets. Those higher prices encourage even more borrowing, which creates even more money, which pushes prices even higher. When you really look at it, your retirement account has barely anything to do with productivity and more to do with interest rates. Viewed through the lens of the Rule of 72, this becomes especially interesting. If debt grows at 6% annually, it doubles approximately every 12 years. If housing prices rise at 8% annually, they double roughly every 9 years. If the money supply expands steadily over long periods, its effects also compound. If inflation averages 3%, purchasing power is cut roughly in half every 24 years. The same mathematical principle that quietly builds wealth for investors also quietly magnifies debt, increases government obligations, inflates asset prices, and erodes the purchasing power of currency. The Rule of 72 is completely neutral. It rewards whatever compounds. This may help explain why different generations experience the economy so differently. Older generations often purchase homes before decades of asset inflation. Many accumulated stocks, businesses, pensions, or real estate that compounded over time. As those assets doubled and doubled again, their net worth expanded significantly. Meanwhile, many younger families are entering an economy where housing prices have already compounded for decades. College tuition has compounded. Healthcare costs have compounded. Government debt has compounded. The cost of raising a family has compounded. Many find themselves taking on larger mortgages, larger student loans, and greater financial obligations simply to achieve a standard of living previous generations reached with far less debt. Critics argue this creates a system that increasingly depends on new workers entering the labor force, consumers continuing to borrow, businesses continuing to expand, investors continuing to buy assets, taxpayers continuing to fund government obligations, and confidence remaining intact. Supporters of modern central banking strongly disagree with describing this as a Ponzi scheme. They point out that real economies produce goods, services, technological innovation, scientific breakthroughs, entrepreneurship, and genuine increases in productivity. Governments collect taxes, businesses generate profits, and central banks operate under legal mandates designed to promote financial stability. Yay, right. The modern economy is simply money moving in circles because real wealth is created every day through human labor, innovation, and enterprise. However, with a system that has unjust scales, that real wealth is stolen from the many into the hands of the few. I argue that even genuine economic growth now operates within a financial structure that has become increasingly dependent on expanding debt and continual monetary growth. Whether that comparison is persuasive or not, it raises an important question. Can debt, government spending, asset prices, and the money supply continue compounding indefinitely in a world with finite resources and finite populations? No one knows the answer with certainty. However, I can speculate and see that the birth rate continues to decline, which means that those contributing to the financial Ponzi will also decrease. At some point, the entire system is unsustainable, and there goes your retirement account. Regardless of how this will play out, everyone should understand the mathematics. Because the rule of 72 isn't really about investing. It's about recognizing that everything compounds. Wealth compounds, debt compounds, inflation compounds, government borrowing compounds, housing prices compound. Even economic policy compounds over time. The mathematics don't care whether you're investing in an index fund, paying off a credit card, buying your first home, or trying to preserve your purchasing power. Compound interest is neither good nor bad. It simply amplifies whatever it's applied to. For those who own productive, appreciating assets, it can become one of the greatest wealth-building forces ever discovered. For those trapped under compounding debt, continually rising living costs, or declining purchasing power, it can quietly become one of the greatest financial headwinds they'll ever face. Perhaps that's the real lesson behind the Rule of 72. It isn't merely a formula for doubling your money. It's a formula for understanding the invisible forces shaping the modern financial system. Because, in the end, math doesn't care about politics, opinions, or economic theories. It only cares about what compounds.